So welcome everyone. Today we have the pleasure to have Patrick Noon, CPA from PJN Tax Solutions Group, Inc. Thank you, Patrick, for joining us this afternoon on a Sunday. I really appreciate your
No
time.
problem. Thank you. Thank you.
And so the reason why we decided to bring Patrick on board is because it is so critical and fundamental for all of you to understand the differences between the entities when you're going to be in real estate, when you're going to do flips, wholesales, buy and holds, what type of entity you need to have and why. So Patrick, welcome, and the floor is yours.
Thank you, Hugo. Thank you. Good afternoon, everyone. Like Hugo said, my name is Patrick Noon, CPA with PJN Tax Solutions Group. We are located in St. Charles, a western suburb of Chicago. And a little bit of a bio on me is graduated from DePaul University in downtown Chicago in 1981, passed the CPA exam in 1983, and have been doing accounting and taxes ever since. So that's about 40 years now. So I'm finally starting to get the hang of this tax thing. And that's what we're going to talk about today is different tax entities. And before I forget, I have here, and Hugo has it as well, this is what's called the entity. That's the entity comparison chart, and it's only 2 pages long. It's not a long read, but the beauty is it's a side by side comparison of the good, the bad, and the ugly of each different type of tax entity, and how they are recognized by the IRS and also by the courts, which is very important. When I'm sure Hugo will touch more on that later. Um, but basically, there are 5 different entities that the IRS recognizes. The first one is called a sole proprietorship. Second one is a partnership. Third one is a C corp, and then an S corp, and then finally the fifth one is an LLC, which is short for limited liability company. And there on the screen now is a wavy version of the entity comparison chart. I think I have a cleaner one back at the office, so when I'm back there early tomorrow morning, if you'd like one, if you can't read this one, just let me know and I'll email you another one. So basically, the first entity to the far left is a sole proprietorship, and that is the quickest and easiest way to get into business. You could set up a sole proprietorship in the next 30 minutes if you wanted to. Okay. As far as how it's recognized by the IRS, a sole proprietorship only can have one person. Obviously, if you have more than one, you're no longer a sole proprietorship. Now you are one of the other 4 entities. As far as taxation goes, that's probably the worst entity to be from a tax standpoint because you pay what's called self-employment tax and you pay self-employment tax on the net income of the business as well as income tax. And that self-employment tax is at 15.3%. The minimum tax bracket under the new Trump tax laws that went into effect a couple of years ago is 10%. And then, of course, you have 4.95 or call it 5% to make it easy for the state of Illinois. So typically 30% of your net income from operating as a sole proprietorship, you'll pay in taxes. There's other entities out there that we'll talk about today that offer less of a tax exposure. As far as the other thing too, the most critical thing about a sole proprietorship is personal liability. When you are a sole proprietorship and you were to be sued by someone and the judgment went against you and the judgment exceeded your insurance, your errors and omissions or your liability insurance, the person that won the lawsuit could then go after your business assets. And if there still was not enough to satisfy the judgment, then they could go after your personal assets. So you, your wife, kids, husband, significant other, you could lose everything. And in today's very litigious society, it's not a question of if you will be sued, but rather a question of when. Because all you need is some hotshot lawyer that just came out of John Marshall Law School, wants to make a name for himself, and if you are on the wrong side of it, it could be detrimental. So although it's the easiest entity to set up, it's probably not the most advantageous. Some of the advantages of a sole proprietorship are, again, minimum legal restrictions. You don't have to have annual minutes or board meetings or election of officers or anything like that, like you do with a corporation. Also, there's no additional tax returns to file. So when people come to me in their sole proprietorship, besides trying to talk them out of it, all I have to do is one return, their individual return, called Form 1040, and attach to that what's called Schedule C. C as in cat. And on that form is where you report the activity of the business. Okay, so again, it is easy to get up and running. You could probably have it, in the next half hour if you wanted to. But some of the disadvantages are, again, unlimited liability. You have everything at risk, not only business-wise but personal-wise. Income cannot be deferred, and there is a lack of business continuity, meaning that the entity, when the owner dies, so dies the entity. It doesn't continue on after their death. The next entity is a partnership. And obviously, with a partnership, you need more than one person. You can't be a partnership if you're on your own. So there are two types of partnerships. One's called a limited liability partnership, or sometimes you'll see the abbreviation LLP after the name of the entity, or the other one is a general partnership. And the difference is, if you are a limited partner in a limited partnership, you only have at risk what your investment is in the entity. Okay. Contrast that though with a general partner, and if you are a general partner in a limited liability partnership, you have everything at risk. Again, because you are considered a general partner, you're involved in the daily operations of the business, the decision making, the filing of forms, tax forms, sales tax, everything. So when you are a general partner in a partnership, it's very similar to almost being like a sole proprietor in the previous entity, in that there is no limit to what you have at risk. The beauty of a partnership, though, is that the partnership itself does not pay income tax. What happens is, when I prepare your partnership return, each of the partners will receive what's called a Schedule K1, and that comes from a section of the Internal Revenue Code. Schedule K1 lists out each partner's share of the income, the losses, the items that receive special treatment like interest, dividends, charitable contributions. All of those items are listed on the K1, and what happens then is the K1 moves over and becomes a part of the individual partner's personal income tax return. I have some clients that have multiple K1s, 3, 4, 5, 6 K1s that we need to get in before we can file their return because of all the different activities that they are involved in. And again, there is a small replacement tax paid to the state of Illinois. I believe it's 1.5%. But as far as the IRS goes, or federal income tax, the partnership does not pay. They file what's called Form 1065. It's the third line down on the entity comparison chart. They file Form 1065. It's a separate filing. And again, Once it's determined what the net income or net loss is, those items then get reported by the individual partners. Now, if you don't have enough basis or skin in the game, if you will, in the partnership, you won't be able to write off those losses. Instead, what you'll have to do is carry those losses forward into the future. And when you either get out of the partnership or you have enough basis, then you can start recognizing those previous losses that you were not able to report on your personal return because, again, you didn't have enough basis. Okay. Partnerships, they're not as freewheeling as a sole proprietorship, but they also don't have the same restrictions of a C Corp or an S Corp that I'm going to talk about now. With a C Corporation, basically that is, if you think of a C Corporation, you think of the big corporations like General Motors or Microsoft or Tesla or Amazon. Those are what's called C corporations. And again, they file their own income tax return and they pay their own income tax. Okay. When Microsoft, fills out their return, not all of the shareholders of Microsoft need to pick up their share of the income or loss. The C corporation basically stands on its own 2 feet and they file their own income tax return. And with the new Trump law that just went into effect a couple of years ago, instead of a progressive rate of income tax, C corporations only pay a flat 21% from $1. Okay. Again, C corporations, there is a limit as far as liability goes. With regards to the individual shareholders, they're only liable to the extent of their investment in the corporation. They file their own tax return. Let's see what else I have here. It's basically a business entity that carries its own legal status, separate and distinct from its owners. Its corporation cannot, out of corporate, a corporation they cannot elect out of corporate taxation. Again, they pay a flat 21% based upon the new Trump law. And it's not considered a pass-through or a flow-through entity. A Schedule C, a partnership, and an S corporation that I'll talk about next are all considered flow-through or pass-through entities. And when Trump came up with the new flat 21% tax for C corporations, the other taxpayers, that were in these other entities, partnership, S corp, or sole proprietorship, they said, "Hey, you're giving these C corporations a nice tax break at a flat 21%. What about us? What do we get?" And so they came up with this thing called QBI. QBI stands for Qualified Business Income, and in general terms, if you are a flow-through or a pass-through entity, like a Schedule C, a partnership, or an S corp, 20% of the net income from the business gets written right off the top and not subject to tax. So let's say, for instance, you had net income of $100,000 from your partnership or your Schedule C or your S corp. In basic terms, 20% of that $100,000 or $20,000 would not be subject to tax. Instead, you would only pay tax on $80,000 worth. So that was a huge benefit that came out of the new Trump tax law. Again, it's called QBI, stands for Qualified Business Income, and it's a 20% deduction on the net income from a pass-through entity. And the reason they call them pass-through entities is because the income or loss is not taxed at the entity level. Instead, it passes through to the individual owners, partners, or shareholders. Okay. Let's see. The fourth entity. And by the way, if any of this stuff, is not making a whole lot of sense to you, which I understand because I've been doing it for 40 years. And like I said, I'm finally getting the hang of it. Um, if you have any questions on this, we'll be glad to take them at the end. Or you can contact me at my office tomorrow, either via the website or my cell phone. Just before I forget, my cell phone is 630-415-5296. Again, 630-415-5296. Or better yet, visit our website, which is pjntaxsolutions.com. So P as in Peter, J as in Joseph, N as in Nancy, TAX solutions with an S on the end.com. Okay, all right, now back to the program. The S Corporation is the fourth type of entity that the IRS recognizes, and it gets its name from Subchapter S of the Internal Revenue Code. And it operates in a very similar fashion to a C Corporation, but again, unlike a C Corporation, the net income or net loss, just like a partnership, it flows from the S Corp to the individual shareholders, okay, based upon their percentage ownership in the business. So if you're a 25% shareholder, then you're going to pick up 25% of the income or loss on an annual basis that the S Corporation generates. There are restrictions on who can be a shareholder and who cannot, so you got to be careful that you are within the guidelines. And the other thing too that a lot of people don't recognize is when you have distributions, each of the shareholders have to receive the same amount of distributions. Otherwise, they're considered to have more than one class of stock, and that is something that can kill an S corporation. And when an S corp is terminated, you have to wait 5 years before you can get back in the game with the S corporation. So you want to be careful not to be in violation of any of the requirements to be an S corporation. There are requirements such as, you can't be a corporation in an S corporation. I believe you need to be a U.S. citizen. Like I said, you can only have one class of stock. You can't have two types of stock. So there are limitations. I've never heard of the IRS actually, going after anybody that didn't meet them, but it is law, and if they had the resources and the time, I'm sure they would. So you want to be careful that you meet all the requirements of an S corp. And again, an S corporation does not pay its own federal income tax. Instead, the individual shareholders report their share of the income or loss on a K-1. There is a small amount of tax paid to Illinois. It's 1.5% replacement tax. But here's the beauty of an S corporation, and I'm sure Hugo is going to speak more about this, is that if you have multiple buy and hold or rental properties, let's say you have properties A, B, and C, okay, if they are each in their own separate corporation or even in a series LLC, then each one stands on its own 2 feet, meaning that with winter coming up, let's say somebody slips and falls at property A, if they're all in the same entity, properties A, B, and C, then they're all at risk, okay? The thing to do is you want to make sure you set up firewalls or insulate one property from the liabilities of others, so that if you do get sued on property A, property B and C are not at risk. And again, with the corporation, you have limited liability versus a sole proprietorship where you have unlimited liability. So again, being a litigious society that we're in, you certainly want to look to operate your business, even if it's a fix and flip, operate it, because all you got to do is have somebody put a nail through their hand with a nail gun, and now you have a lawsuit. And if you're not incorporated, again, you got a lot of exposure. So whether it's a fix and flip, a wholesale, or a buy and hold, it's always good practice to set up a corporation. Now, I don't do that. I'm sure Hugo has attorneys that could do that. LegalZoom is another entity that could help you set up a corporation. Typically, if I get involved with creation or establishment of a business, it will be to get a tax ID number from the IRS. It will be to do the S Corp election, which is IRS Form 2553, and it would be to register the corporation with the state of Illinois. Okay, but again, S corporations, you know, they operate similar to a partnership. Everybody picks up their share of the income or loss. There is limited liability, though, to the extent of the investment. And it does file its own separate return. It's called Form 1120S. Probably for 2019 tax year, we will wind up filing probably north of 400 returns, maybe closer to 500. And typically it's a 2/3, 1/3 breakdown between individual returns and corporate returns. So if we did, you know, let's say 450 returns, I'm going to say at least 150 of them are going to be the business entity. I did 2 this morning before the webinar. Went into the office, did 2 S Corp returns for the same individual client. So that's kind of how it breaks down. The last one is crazy. It's called a limited liability company. Okay. And unlike the first 4, it does not have its own separate tax return. So in other words, an LLC does not file a specific type of return. As a matter of fact, an LLC can take on the entity characteristics of any of the first 4 that we spoke about. When you set up an LLC, and not talking about series LLC, but just a general LLC, if you do not make an election to treat the LLC as a partnership or an S Corp or C Corp, then what it does is it defaults to a sole proprietorship. You'll also hear people use the phrase disregarded entity, okay, or single member LLC. What that means is that entity files Schedule C as part of the individual's personal return. Once the LLC is set up, you do have the option of having the IRS recognize it as either a partnership, a C corporation, or an S corporation. I believe the form number is 8832, where you make the election and you let the IRS know, hey, we just set up this LLC and we want it to be recognized as a C corporation, okay, or an S corporation, or whatever you decide to do. If you don't make the election, though, the default is to be recognized as a single member or a disregarded entity. LLCs are also, they have limited liability characteristics, so it's another reason why you want to set up an LLC. And Illinois is I believe, one of the few states that recognizes series LLCs. And they're a little more expensive to get up and running. But what you have the ability to do is acquire multiple properties. They're called cells, like a cell phone. You can acquire multiple properties. They're known as cells. And instead of having to file a separate income tax return for each piece of property, they all come together and you file one overall tax return. I would recommend, however, that if you do a series LLC and you start to acquire multiple properties, that you open up a separate checking account for each property, so there's no commingling of funds between properties. You would set up a separate checking account. I would also request that you set up a separate credit card, okay, and also have a separate set of books and records, whether it be Excel or QuickBooks. Treat each property as if it stands on its own 2 feet and don't mix and match the activities of one property with another. QuickBooks, I believe, has the ability to let you set up multiple entities. And I would just, set them up using the addresses, 7905 Birchdale or 1823 Tallman, whatever the address is, that would be that property. And then in there, when I would look at the books and records at the end of the year to do the tax return, there would typically be, if it were a normal year, there would be 12 deposits, which would represent the 12 months of rent income received. And then there would be disbursements for real estate taxes, maybe mortgage interest, cleaning and maintenance, HOA fees, insurance, things like that. And then, like I say, you get down to just, a single net income for that property. But if they're in a series LLC, then what you're able to do is bring them all together and file one big overall encompassing return instead of paying me to do multiple returns, which would be crazy. So that's kind of a quick half-hour overview of the different tax entities. Again, I'll be glad to answer any questions. And Hugo, I know he always likes to speak a little bit about the different entities that he prefers as well. I would say, again, if it's a buy and hold, I would look to LLC, maybe a series LLC. If it's a fix and flip that you're doing, then maybe an S corp. So that again, you don't. The beauty about S corps, I forgot to mention, is unlike a Schedule C or sole proprietor, an S corporation does not pay self-employment tax. Okay, the only tax on a K1 is regular income tax. However, the IRS does want you to take what they consider to be a reasonable salary. Well, there's really no hard and fast rule or measuring stick on what is considered a reasonable salary. It's not a certain percentage, it's not a fixed dollar amount, but it'll be things the IRS will perform tests such as what would you pay somebody to do what you do if you were able to do so, or what would you expect to be paid if you went to go work for another company, considered reasonable salaries. Some of my clients, they're very conservative, and they'll say, okay, if the net income of the business is $100,000, give me half of it on a W-2 and the other half on a K1, and they'll consider that reasonable. I've never had the IRS question that, although nothing's guaranteed when dealing with them, as you all know. I've heard of other CPAs that will do a 4-to-1 split on a W-2 versus K1. So in that same example, if it were 100,000 net income, there's some people, some CPAs, some clients that are a little more on the aggressive side, and they'll say, okay, 100,000, give me 20,000 on a W-2, and give me the other 80,000 on a K1. That might be pushing the envelope. And I say to my clients, I say, okay, here's the line. You decide how far away from that line you want to go. Some people want to stay right on the line because they need the headaches, and there's other people that are a little more aggressive, maybe the gambling type, and and they'll push the envelope. So again, that's another big distinction with S corps. I know you like to talk about what you prefer. I'm having a hard time hearing you. No, still can't hear you, Hugo.
Can you hear me now? Is that
Yes.
better?
Now I got you. Now I got you.
Okay, perfect, perfect. So the question is, if I'm doing both fix and flip and buy and hold, should I have both an LLC and an S corp?
In my opinion, yes, you
Sure.
should. And the reason is, again, if everything's in one big pot, then everything's at risk. But if you operate the fix and flip as one entity and the buy and hold as another, then there's a separation between the two, and there would also then be a limit or a firewall in between the two entities as far as liability and a lawsuit goes.
Okay. Then Robert is asking another question. Are you able to see the chat, Patrick, with the questions?
Let me see here.
It's from Rob.
If I, is this where he says if I sign a REPC? I don't know what that. What's an REPC? With and/or signs, and I need to create an LLC quickly. How quickly can you get it done? You can pay an expedited fee to the Illinois Secretary of State to have it created. You used to be able to go into downtown Chicago to the Secretary of State office, but with all this COVID-19 going on, who knows? You know, I would say call the Illinois Secretary of State. They are answering their phones. A lot of them are still working from home, but they would be able to direct you. And again, in the old days, you could get it set up in a day or two if you needed to. But with COVID-19, everything's a little bit further behind. Oh, I get it. REPC, Real Estate Purchase Contract.
Right.
Thanks, Rob.
Okay, friends, so let's just quickly summarize why to create your entity. There are three main benefits. Number one benefit is asset protection. So if you get sued, all your personal assets are protected. Okay, so that's number one. Number two, for tax benefits, and in real estate, especially buy and hold, one of the biggest tax benefits is depreciation. Okay, so that's going to help you write off a lot of expenses, and then therefore you're going to be better off when to your tax returns. And finally, funding. Okay, when you have your entity, you're able to get business credit cards, as Patrick mentioned earlier. You're also able to use your money from hard money lenders and private money lenders. And the reason why is because if you default the payment on the mortgage, then a lot quicker. It's going to be a lot quicker to foreclose on your property versus personal name. If it's your personal name, it can take up to years. If it's under your entity, they can do it as fast as 6 months. So that is the most hard money lenders or private money lenders will always favor your entity. So those are the main three benefits of your entity. And then when you only have three options in real estate: buy and fix and flip, wholesaling. So many people think that they need to create, so if they buy, let's say, two, they think they need entities. Okay, property, two entities. That's not the case. So you're going to be created, as Patrick mentioned earlier, an entity driven by equity. Okay, so if you have 10 properties, but if you have very little equity in those properties, you can put them all in that entity. However, once you start reaching the $500,000 equity threshold, then you need to start moving properties into new entities. Okay, now which one should you create? For a fix and flip, for a buy and hold? Really doesn't matter. My personal preference is an S corp if it's just one individual like yourself, and if you have more partners, then an LLC. Okay, that's simple. So we stay away from C corps because of double taxation. Okay, and then the other ones that Patrick mentioned, it's just too risky because your personal assets are not protected. So again, if it's only yourself doing real estate, S corp. And if it's you and other partners, you are your spouse, you else, LLC. Very simple. And then you can use those entities to do your transactions. And again, do not create an entity per property. You can use the same entity. It's going to be driven by the equity that you have in the property. So what does that mean? It means that, let's say you buy the property for 100,000, you put in 50,000, 200,000. So you have 50,000 in equity. So you need to accumulate about 10 of them before you start creating a second entity. And the reason why is because every time you create an entity, you're going to need to file taxes on the entity. So there's a lot of overhead involved in each entity, and you have to pay the state yearly fees, the creation of the entity. So you want to minimize overhead if you don't need to. But what Patrick mentioned earlier is very important. Please do create separate checking accounts. That's going to simplify your accounting for every single property. But it doesn't mean that you're going to need to have different entities. He said different checking accounts per property, okay? That belong to one entity. So for one entity, let's say ABC Inc., you can have multiple checking accounts, okay? So you want to do that per property so that you keep everything separate when it comes to your profit and loss and your income. It's super important. Are questions on the line? Oh, okay. There's another question. If wholesaling, which entity is better? So for wholesaling, since you are not buying the property, you are not funding the property, you're not making any repairs, all your wholesaling is reassigning the rights of the contract to a third party or an investor, a cash buyer. So it doesn't really matter. You can use an LLC, you can use even your personal name because there's no risk involved in it. A lot of people use trusts when doing wholesaling, but again, for wholesaling, it's very flexible. It does not matter. But when you do fix and flip and buy and hold, since you're actually buying the property, your liability risk goes up significantly. Therefore, you've got to have an entity. And the entity is driven by how many members are in the entity. Multiple people, LLC, single individual, S Corp. Another question. It's just me, but I have an LLC. Yeah, that's okay. You can have a single member LLC. That's not a problem.
Right.
LLCs
Just remember
and
though,
S Corp double taxation. As Patrick mentioned,
Okay, how much typically it takes to move the property to LLC? Let's say I have no LLC, but if I start LLC and if I'm moving my property to LLC, how much typically it costs?
I wouldn't think it would be much. I mean, that's more of a legal question for an attorney to retitle the property out of your name and into the name of your business, I would think. And, you know, I don't, maybe even Chicago Title could do something like that for you by putting it into a land trust. You know, that again, that's probably more of a legal question, and I'm not an attorney, so I would check further into that, and I'm sure Hugo has attorneys, you know, on standby that could help you out with that question.
Thank you, sir.
right, and usually you do a quit claim, so you can quit claim the property to your entity or vice versa from your entity to your personal name. Because when you buy a property, let's say using a Harmony lender, it's going to be under your entity. But some lenders on the back end, when you want to refinance, they want the property to be on your personal. So you do a claim that is very easy, very inexpensive. Each village has fees to do a quit claim deed, but obviously that needs to be approved by the lender. So if you buy a property and then that's going to be under your entity, technically the lender needs to be okay if you're going to quit claim that property to a different name, okay? Because otherwise they have a clause on the note or the mortgage that says due on demand. So when you make a change of that event, you know, technically the whole note is due. But those are technicalities. As Patrick mentioned, we'll have Castle Law, Gary Davidson from Castle Law, who can help you with quitclaim deeds. So it's just a simple document, one-page document for that. So it's very easy,
Thank you.
very simple. You record that, and boom, it's done. So no problem. Are there any other questions on the line? Okay, so I'm going to share my favorite sources. It's LegalZoom. That's my favorite source to create entities. Okay, typically they charge between 400 up to 650 or so to create an entity. Okay, it can take up to a week. They're going to give you the article of incorporation, bylaws, operating agreements, everything that you need in place to start business, okay, to become legal. They even give you the EIN number, which is going to be the one that you use to file your taxes. Okay, so LegalZoom, make sure that you create an entity. And again, the main benefits is funding, benefit, asset super and tax protection. Super important, okay? Make sure that if you are serious in real estate, that you do have an entity. You're going to have tremendous benefits. Not only that, but now and then, you have an entity. SBA, the Small Business Administration, gave money, so we gave loans under your entity. Just to cover up for all the losses due to COVID. So it's huge. You know, they had a fund for 3 billions and they made that available twice. It's huge. Okay, many businesses are getting that incentive, so you can get a loan from the SBA. And again, everything is done through your entity. Nothing is going to go to your personal name. So that reinforces the importance of you having an entity when you are in real estate. Super important. Oh, thank you, Phil, for posting Gary Davidson's contact information. Single LLC covers more than one state's property. Yeah, absolutely. Absolutely. And then once you have your property under an entity, LLC, S Corp, you still need to have a policy just to cover up in case you get sued. That is super inexpensive, about less than 150,000 for like a family. That 15 is, you know, the lawsuit is huge. So it's super important to be protected. Not only the asset itself, but also your personal property. Are there any other questions on the line? Is one bank better than another one? Business account? Great question. My preference is I love Bank of America. We have with Bank of America, Chase, but I think we have banks everywhere, and they're easy going when it comes to fees, bank fees. Okay, the ability to waive some of the you know, for whatever reason you get assessed versus Chase. You know, they're less flexible, let's put it this way, but it's also a great bank. But my personal preference is Bank of America. Also, when it comes to business credit cards, Bank of America is like, to me, number one option. When it comes to business credit cards and extending or increasing your line of America, by far way better. Chase, it's also good, but not as good as Bank of America. Great.
I have my corporate accounts with BMO.
Any other questions?
And they charge $15 monthly service fee. And I always ask myself, what are you doing for this $15 a month? But that's what BMO charges. And I'm just lazy. I've been with BMO for many, many years. And but again, yeah, I would look around, and the biggest question is, what is your monthly fee? there's some banks, if you keep a certain minimum balance, there'll be no fees at all.
Absolutely. Thank you. So friends, I want to make sure that you have already RSVP for our next live bootcamp event, which is August 30th. So this coming Sunday, we're going to run a bootcamp. It's going to be live at the DoubleTree. Let me pull up the event. So right here, bootcamp. Okay, so this is a live event. Make sure that you RSVP. We're going to be covering everything on hold, fix, flip, and buy and hold. So please make sure that you RSVP. It's going to be at the Oakbrook. It's going to be a great event. We're going to give you our secret how to build a $1 million empire with rental. So it's going to be super cool. We're going to couple. So it's going to be super cool. So it's going to be very, very exciting to see you all there in person. So if you have not RSVP, please make sure to do so. And if there are no further questions, we're going to give you access, a free trial to Chicago Deal Vault, because we want to make sure that you have access when you come to the bootcamp. We're going to be referring to some of the off-market lead pipes that we have in Chicago Deal Vault. Phil, can you post the registration form online, please? And then so let me pull that up. Okay. So I'm going to give you a promo code so you get it for free for the next 30 days. Okay, we're going to train you one-on-one, and we're going to be giving you also for the next 30 days access to our resources so that they can help you find great off-market deals. Perfect. Thank you, Phil. And the promo code is Patrick. Okay, so you're going to get 30 days. 30-day free trial. Okay. And also posted Patrick's contact information. Make sure that you reach out to him. He'll be able to assist.
First consultation is always complimentary.
Thank you, Patrick. So, friends, thank you for joining today on a Sunday. We had a great crowd, close to 30 people. I look forward to 30th at 1 p.m. DoubleTree Oakbrook. And we're gonna cover pretty much, make sure that you have foundation, there's and about wholesaling, fix and flip, and buy and hold. And most importantly, and everything that we our secret formula to build a higher recycle money, and we'll also do a speed networking event. So I look forward to seeing you then. Patrick, thank you very much for joining us today and giving us such a great presentation today. I greatly joining. I look forward to seeing you. Appreciate it. So thank you everyone for joining you tomorrow. Okay, we have a webinar tomorrow, 6:30.